So this topic is called performance evaluation and emerging issues. And what happens here, it is an extension of standard costing and variance analysis. Remember standard costing, we were comparing the standard costs and the actual costs. And we said standard cost is what is expected to be incurred or to be achieved under normal circumstances. So in performance evaluation, we look at now what did we expect to see or to achieve, or how did we expect to perform vis-a-vis how we actually performed. And that's why we are saying that performance measurement refers to the exercise of comparing actual and expected performance. That's what we call performance measurement. It's simply an exercise where you compare the actual and the expected performance. Now, the primary objective of doing this is to ensure that the original objectives are being achieved. Now, for us to have an expected performance, we must be coming from a particular objective that we want to achieve this. So what we want to achieve is our expectation. So finally, when we have done what we are doing, what we achieve is the actual. Now we compare our expectation in the actual. And that means we are trying to ensure that what we initially set out to do is being done. And that's why now this one will be done. This is an exercise that will be done by the owners of the company. They are the ones who will be more concerned about the original purpose. However, it can also be done to get a basis or a ground for rewarding people or punishing people. It can be done as a ground if we want to punish people in the organization or to reward. What will be the basis? Performance evaluation comes on board. Now, in order to do this effectively, a company is divided into what we call responsibility centers. Now, these are centers, or these are points where we have managers, and then each manager is held accountable on the basis of a particular item that they are in charge of. Now, a good responsibility center should, number one, be clearly defined in terms of boundaries. If I am the one in charge of this department, I should know where my territory begins and where it ends. There should be a direct link. You should be connected with the people that you are leading, and then the categories of cost must be well defined. And this is the reason why you saw when we were in variances, we could compute variances for material, for labor, for overheads, fixed and variable, for sales. They are well defined. Now we have four types of centers. One is called a cost center. And this is where the manager is held accountable on the basis of cost. So huyu ile swali mnaulizana ni how much cost did you incur vis-a-vis what we expected. And that is judged on the basis of computing the production cost variances. The variances you are computing here, you look at whether it is positive or negative, and then you make a conclusion. We have another center called revenue. This is where the person responsible is responsible for revenues. So these are the marketers, the sales guys. So we only look at how much sales did you make. And that one is done by computing what we are calling the sales variances. We have the profit center. Here, the manager is held accountable on the basis of the profits that they have made. So we look at how much profit did you make, and this guy then must be able to be in charge of cost and revenue, because profit is equal to revenue minus cost. The other thing is called investment center. This is where the manager is held accountable purely on the success or failure of what we call capital budgeting decisions. So these are decisions that are formed in companies, and they are long-term, and they involve huge outflows of money. And that's why these ones are either done by very senior guys or the owners of the firm. If you want to judge them, we look at return on investment, residual income, economic value added. Those are the items that we use. We will be computing all this in a while. Now, when you want to judge performance, there are two categories of measures that you can use. You can look at the financials. So this is what you can quantify. Like now, if you want to judge my performance as a teacher, you can look at how many lessons I was supposed to have taught you this week or this month, and how many have I taught. That's something you can quantify. And when it comes to financials, we use these three, the ones we have just mentioned here. Then you can also look at non-financials. Non-financials is where you want to judge me as your teacher, but what you are using to judge me, you cannot quantify. So you're looking at things like confidence, the audibility, my eloquence, my competence, my creativity, dressing, integrity, and such on and such on. So those are things that at times people ignore, but they have a great impact on performance, and they should be captured when we are judging performance. Now, this is well discussed in something we call the balance scorecard. If you have done management, leadership and management, I know you have come across balance scorecard. Now, still at it, when you are doing performance measurement, other than using the financials and non-financials, it is also to be very clear whether you are judging the performance of the manager or the performance of the division. Like now, in a class like this one, you could ask, are you judging the performance of the teacher as a teacher, or are you judging the performance of the class? So the performance of a teacher is managerial. So this is where the manager is the one who is the subject of the appraisal. And we now look at personal attributes or characters. When you look at divisional or economic, we are looking at the division, and we are simply looking at the results. We are simply interested in the results of the division. We have something we call the principle of control. This is also very, very important when you're doing performance appraisal, that you cannot appraise a person on the basis of something that was beyond them. Like, I think there is a day I missed your class because there was no power. Now, you cannot come and judge me or want to punish me why I never taught. It is because there was no power and it's beyond me. But if there was power, internet ilikuwa, wanafunzi walikuwa, na mimi sikuwa mgonjwa, and I was just idling here in the office or in the house, and I did not teach. Now that one was within my control. I should be judged. So when you're judging people, it is important to observe this concept and remove that which is beyond them, and only include that which is within their control. Now, in compliance with that, then, when you want to prepare an income statement, this is how it's done. You get the external sales. This starts with transfer pricing. You come to internal sales, transfer pricing, total sales, less variable cost. You get something we call short-run contribution. You less what we call controllable, avoidable fixed costs. Those are fixed costs which the manager can avoid, and they are fixed costs. Things such as small office equipments, like staplers and so on. We get what we call controllable contribution, and that is the one that should be used to judge managerial performance. Then for the you less the non-controllable, avoidable fixed cost. Those are fixed costs which the manager incurs, but they can control, but they cannot, rather they can avoid them, but they cannot control. For example, if the manager wants to have a van, maybe a sales van, the sales manager. So the sales manager can avoid whether to have the van or not. But when it comes to buying the van and even maintaining the van, that is a task for the head office. So it is him just to go and say, I need a van. Mahali watatoa ama watanunua pesa ngapi, that is beyond him. Now, when that happens, we get divisional contribution, and we less now the head office costs that are shared, and that gives us divisional profit. So that's how the statement is done. Now, the return on investment, which you have mentioned, it shows the amount of returns that are generated by a given investment. And this is how it's computed. Operating income, you divide by the operating assets. And using something we call DuPont, is a guy who suggested that these two can be broken further. So we have margin and capital turnover, where margin is income over sales. Then capital turnover is sales over assets. And remember, assets that should be used is total assets less current liabilities. That's also what we call capital. Now, marginal turnover, margin and capital turnover are inversely proportional. What that means, if you want to be liquid, then you cannot invest. But if you want to invest, then hautakuanga na pesa, because pesa ukipata una invest. So the DuPont analysis enhances what we call management by exemption, as in you can be able to see an item on its own, as opposed to looking at the totality, as looking at what I would call the mob justice or the mob perspective. Now, ROI is preferred for economic performance. And when you are appraising a project based on this, we should always take a project if the return on investment is greater than the existing ROI. We shall do a question on that. Then we have what we call the residual income. So this is the excess. This is the excess of the profit over the cost of capital, and it's computed as residual income. Residual income is divisional contribution minus the cost of capital. And this is the one that we use for managerial performance. And when you are judging this, when you want to use this as the method of appraising the project, what you do, you compare the project's ROI and the minimum required rate of return. And if ROI is greater, then you accept that project. Otherwise, you reject it. Then there is something we call the dysfunctional consequences of using short-term financial measures of performance. Now, I have already said that this performance measurement is used to as a basis of deciding whether to punish a person or not to punish. So managers, when they realize that they are likely to be punished or to be rewarded, they can manipulate the results. When they manipulate the results, then we have what we call dysfunctional consequences. A dysfunctional consequence is a result or a consequence that was not originally intended, or is a result that eventually will be more harmful. Now, these short-term financial measures, we call them short-term because the maximum they extend is 1 year. You know that is the maximum period we prepare the statements for. It's 1 year. So that's why we are calling them short-term. So managers can manipulate the results. Yeah, we are saying that they can be manipulated. Even yourself, most likely, ukisikia kuna mahali utapata reward, you are likely to manipulate the results so that you get a bigger reward. Ukisikia kuna mahali you'll be punished, you are likely to manipulate the results so that you don't get punished. Now, there are 3 ways, or there are 2 main ways in which managers manipulate the results. One, they reject a project which has short-run outflows, but long-run inflows. And this now, if this will be happening, you find that we are threatening the going concern. You see, it's like someone who does not want to invest. Yeye anataka akilipwa mshahara anakanga tu nayo, anasikia kwa mfuko ako na pesa. Now that person is rejecting the short-run outflow, but they are going to affect their future because they don't have anything that is going to generate that is going to secure their future. Then we have what we call use of unpopular labor policies. This is where the managers they have targets to meet, they have deadlines to meet, and they are way behind what is expected. So they make people to work overtime. And when people work overtime and they are not being paid overtime premium, they start complaining. Now that complaint is likely to affect the results. is likely to affect customer dissatisfaction, because you go to an office and you find people are tired, people are dissatisfied, and they don't want to cooperate with the customers. Not that it's their nature, but because they have been overworking. Someone has been forcing them to overwork without a pay. And then now whoever suffers because of that is the customer. The other thing is the other thing is that for you now to remedy this, there are 3 ways we use. One, you lengthen the measurement period. So instead of kupimia watu for 1 year, you can make it longer, so that within those periods, things are able to turn around and about, and they get to a place where it will be beneficial both to the organization and to the individual. Number 2, we are saying you can incorporate non-financial measures. Non-financial measures supplement the financials. And this will improve the accounting measures by use of or rather will help to give a better picture than just relying on the financials. You also use non-financials. Then you can use the economic value added. Just a minute. Okay, so the economic value added statement is an improved way of residual income that is able to include a few items more. But before we look at that, there is what we call the 2 parts. So we have 2 parts. There is one part that shows how value is created, and then there is another part that shows how value is shared. It's just like the income statement, where we have the revenue and the cost of sales. Then we have the gross profit. Then thereafter, we have the expenses. Now we have the items that are adjusted, or rather economic value added statements. They have the following drawbacks. One, the term value has different meanings in taxation, in economics, in business studies. So when you give them to different persons, they think or they get the meaning in different ways. It also includes suppliers as part of value creators, and suppliers are not part of value creation. Many people disagree. The other thing is that different companies can use different policies when it comes to property. Some will be owning, others will be leasing. When it comes to employment, we have casual and permanent and so on. So the formula for the economic value added statement, this is how it is. You get the conventional income plus or minus the adjustments, then the conventional capital plus or minus the adjustments, and then you multiply by the cost of capital. So as I said earlier, this is an adjusted residual income, because if you remove these adjustments, that formula goes back to residual income. So the accounting adjustments are, number one, if there is interest on debt capital that has been subtracted, you should always add it back. Interest on debt capital should be added back. Vitu kama marketing, advertising, research, goodwill, those are things that are not the day-to-day part or other operations of the business. So they should be added back, and we treat them as assets. We capitalize, and therefore we amortize, or we compute impairment. Non-cash expenses should also be added back. We should not be subtracted from the profit. Then cost depreciation should be added back. Cost depreciation is a depreciation that is based on the cost of the item. But there is also what we call the economic depreciation. This is depreciation that is based on the benefits that the asset is bringing to the farm. So the one that we should charge is the economic depreciation. So if the question has already subtracted the cost depreciation, you are supposed to add back the cost depreciation and you less the economic depreciation. So we will come across a question of that nature, and that maybe will make sense. So I don't know whether there is any concern regarding that. If you have any concern, you can raise it before we proceed now to the past papers. Have I sent you these notes?
Not yet.
Okay. So I've said. So you can take note of April 2023. April 2023, question 1A. Question 1A. It is theory of what we have discussed. The theory of what we have discussed. You shall look at it later. You also look at August 2022. August 2022, question 1C. That is also part of the theory in what the handout we have just discussed. Then from there now, let us go to this question of April 2022. April 2022, question 3A. Homa kanitaka kuninyemelea. April 2022, question 3A. So the question says that Majibo Limited has two divisions, A and B, whose respective performance is under review. Division A is currently earning a profit of that 5 million and has net assets of 150 million. Division B currently earns a profit of 70 million with net assets of 325 million. Majibo Limited has a current cost of capital of 15%. Now, using the information above, calculate the return on investment and residual income for each of the two divisions at the review and comment on your results. And comment on your results. So if we start on return on investment, the formula we have looked at has said it is income. You divide by the net assets. You can multiply by 100. You can multiply by 100. So for department A, the net income is that 5 million and the net assets are 150. So give me that answer. %23.33%. Compute for B as I respond to this call. Okay, sorry. Someone came in and switched off the lights. Okay. I had said you now get for B, division B, which is having 70 against 325. Tell me what is there. $21.54. So that means the comment you can say is that A is better than B. You can see A is generating more than what B is generating. Then for the return on residual income, we have said is the income minus the cost of capital is the excess. So for A, this will be 35 minus the cost of capital is 15%. So this is 15% of the assets, 150. So 12.5. Then for B, it is 70 minus 15% times 325. And 1.25. So this one is better. B is better. Although we have said that residual income is not a very good measure to compare companies or departments because it is absolute and different companies or different departments may have different capitations. Yeah. Then state which method of performance evaluation would be more useful when comparing divisional performance and why. So hii ndio tumesema this is the one that is useful for the divisional performance. Divisional performance. So if you want to measure divisional performance, you use return on investment. And tumesema because it is a relative measure. Yeah, it's a relative measure. Relative measure means it is able to compare more than one factors and expressed in a fair ground. You see now you're looking at the profit vis-a-vis the assets. The profit vis-a-vis the assets. That is better than this one. So here, tumesema the return on investment, sorry, the residual income, this one you use it for managerial performance. You use it when you're judging the performance of the managers. And in so doing, you pocket 10 marks. Let's look for another one. So there is December 2021 pilot paper. Pilot paper. December 2021 is a pilot paper of question number 1B. So the question says that Worker Limited reported a pre-tax income of 21 million for the year 2019. This was after charging 4 million for development and launch cost of a new product that is expected to generate profits for 4 years. Corporation tax is paid at the rate of 30% of the operating profits. The company has a risk-adjusted weighted average cost of capital of 12% and is paying interest at 9% on a substantial long-term loan not charged as an expense in the operating income above. The company's net current assets value is 50 million and net current assets have a value of 22 million. The replacement cost of non-current assets is estimated to be 64 million. Is estimated to be 64 million. So you are required You are required to get the economic value added for the period and then the residual income. And then the residual income. That is what you're supposed to do. So now, number one, we are told, or first of all, the first thing that you need to do is to say economic value added is given as conventional income. Conventional income. You minus or add, so we say plus or minus adjustments. Plus or minus adjustments. You minus the conventional capital plus or minus the adjustments. The adjustments. So this is the one that we should times the cost of capital. The cost of capital. That's how it should be arrived at. Times the cost of capital. So the conventional income will be arrived at as we have the 21 million. The 21 million. Then you add any item that should not have been subtracted. And if you remember what we have said in our discussion, the first thing is research and development. So this cost was charged and should not be charged. So we are supposed to add it back. So we are supposed to add the 4 million. That's one of the accounting adjustment. The next adjustment that we are supposed to have is tax. There is tax, which we are told is 30%. So minus 30% of this operating profit, 21. So that one now will be subtracted. We are supposed to bring interest. Interest should also be added back. This 9%. But we are told they had not charged it. So if they had not charged, then we do not add it back. So sasa ukifanya hivyo, that gives you now what we call the revised profit. The revised profit after including the adjustments. Then we minus the conventional capital. The conventional capital we have just said, it is the assets minus current liabilities. So we are told the company's non-current assets value is 50 million. And the non-current, the net current assets, they have 22 million. The replacement cost of the non-current assets is 64. So that means that the assets or the capital of this company should be the non-current. And we are supposed to take the replacement costs. The replacement costs you add the current. You add the current. The current is 22. We add the current. Then we also have said that this cost here should be capitalized. The one on research should be capitalized. So we are supposed to add back this 4. We are supposed to add back that 4. So when you add back, you multiply now by the cost of capital here. And the cost of capital, we are going to use 12%. We are going to use 12%. So that is how you shall get the economic value added. Yes, so we can see now this is destroying value. It is negative 9.564. When it is negative, it means that we are destroying value. It means we are destroying value. If it is positive, we are adding value. Now, residual income, we had said here, it is the income minus the cost of capital. And I had said earlier on that EVA is the adjusted residual income. So residual income does not recognize these adjustments. So it is just going to take the 21. Obviously, we have to raise the tax. Wherever you are, you have to raise the tax. You have to raise the tax. Then you minus these 64 plus 22, you multiply by 12%. So the residual income will not recognize the adjustments for the research and development.
Excuse Mwalimu.
Yes.
The first one for the EAVI was I'm getting 9.7. I don't know whether I'm correct or wrong.
Okay. Daniel, you can also look at yours. Tell us whether you have different value.
7.9.
You're getting 7.9.
Yes.
Okay, let's have Daniel recheck his. Daniel, do you maintain the same? Should have been 64 plus 22 plus 4, 90 times 0.12. Then I say 21 plus 4 minus 0.3 times 21 minus the answer, 7.9. Yes, Daniel is 7.9. So that means we are adding value. Sasa nipatie hii. Waiting for this now. Daniel, you are reporting a different figure.
I have a question.
Yes.
The cost of capital, or the first one,
Mhm.
are we multiplying it after you've already done the subtraction, or is it multiplied to this the conventional capital?
It's only the conventional capital, this one.
Oh, okay.
Even here. So with that, now we have the figures agreed.
Yes.
Okay, good. Let us go to this one of May 2021. May 2021, question 5B. May 2021, question 5B. May 2021, question 5B. Inasoma, the following information has been provided relating to the performance of XYZ Limited. So we have divisions, the head office. And then we are told evaluate the divisional performance using the economic value added approach. So that question, it is exactly like this one. We are going to use this formula. We are going to use this formula. But now that we have more than one department, we shall present it as a table. And as I said, when you use this conventional income, and you do the adjustments, we call it the revised income. Now, this one is called the revised capital. So this is now what you are going to use again in this manner. So we are going to draw economic value added statements. Where we will have the details we have division X, division Y, thank you, Zuri. So here I have the company. I have the head office. So this is division X. Division Z. So the first thing, just like we began there, is always to bring what we call the conventional income. The conventional income. So the conventional income, you pick any profit that you want that has been presented. So for this question, they have presented to us the profit before tax and interest. The profit before tax and interest. So X imepewa 32, Y imepewa 24, Z imepewa 25, and head office imepewa -9, and then the total is 72. Yeah, those are the amounts that have been given. Now from there, you bring the adjustments. The adjustments. So in a question like this one, where you have something in the head office, either a profit or a loss, that should be subtracted from there, and you distribute it to the departments. So we are going to talk of the head office loss. So the head office loss. Now, some questions will direct you on how to share the head office. According to this question, information 1, you can see they are saying the head office liabilities and net assets are to be shared equally. So if we are supposed to share equally, then what we shall do is here we say -9, you divide by 3. So we bring -3 here. Then -9, you divide by 3, we bring -3. -9, you divide by 3, you bring -3. And then here you put +9 so that nothing gets here. They add to 0. So hii inatolewa. But if the question is quiet on how to share, we use revenue. Naona hiyo sales. Hiyo sales tunatumia as the basis. Just like there's a question we came across when we were looking at the life cycle. So sasa kama ya X ungesema 610 out of 2065 times 9. So if the question is quiet on how to distribute the head office, you use sales as the basis. Now this one is expected that you shall always do that. From there now, you go to the additional information and check whether there is any adjustment that you are supposed to make. Number 1 or information number 2 inasema Division X spent 8.2 on research. So I have told you that should be added back. So the research, it is in Department X, 8.2. And then you also record it in the company here, 8.2. Because everything in the row should add to the total there. Advertising done by division Y. So advertising. It was done by division Y at 9.25. So we also bring it here. Then goodwill amounting to 65 was amortized. So that one should also be added back. All these expenses should be added back. Y ilikuwa na 65. Z ilikuwa na 97.5. So add the two of them, uniambie total. This 65 plus this 97 is 160 what? $160? $2.5. Haya. Cost of capital, hiyo itakuja baadaye tukisha revise capital. Then we are told the borrowings, the interests. Now these interests, they will not affect us. They will not affect us because hii profit yenye tuna deal nayo, this one, it is the profit before interest. So interest had not been subtracted. If it had been subtracted, we would have added it back. But where we have started with, it has not been subtracted. So information number 6 is not going to affect us. So with that now, we can be able to get what I have told you is called revised. And something else you notice, this question has not talked to us about tax. So we are not deducting tax. So this is called revised income. Ni ile tulikuwa tumefungia kwa brackets pale. Ndio inaitwa revised income. So now tell me, this that 2 minus 3 plus 8.2 is what? That 7.2. Division Y. $95.25. Z. 119.5. The company. $251.95. Now from there, you bring the second brackets and chukua nayo pale yenye inaitwa conventional. The word conventional simply means what has been prepared kawaida, in the normal way. That's called the conventional. So the conventional capital in this question, X has 140.5. This other one has 121.5. This is 118.5. And this is 12. Total inakuja 392.5. So after that, now we do the adjustments. So the adjustments, we have the head office assets. So what we are sharing is this 12. And we are already guided, it is 12 divided by 3, that will be 4. This is also 4, and this is also 4. So that here we don't have anything. The next thing is we bring the other adjustments. The first one is this research. It should be capitalized. We have 8.2. You bring it here, 8.2. We have advertising. Is 9.25. We have goodwill. 65, 97.5, 162. Actually, these questions, one thing you notice, except tax, these items that we have added here, they also come here. Just like hiyo ingine ile 4 ilikuwa kwa income na ikakuja kwa capital. So the figure you have is called revised capital. Revised capital. So this 140 plus 4 plus 8.2. $157.2. Huh? Is it 157? So this is 140 plus 40 plus 4 plus 8.4. Ama kuna kitu ingine? Yes, 152.7. Yeah, good. The next one. $199.75. The next, $220. The total huko. $572.45. Then cost of capital. So this is what, Daniel, you're asking whether we are multiplying by what? So the cost of capital is 14%. So it will be 0.14 times 152.7. That's 1.378. The same case here, 0.14 times 199.75. 27.965. Haya, 0.14 times 220. 30.8. Haya, now get the same for this one. 14% of 572.45. $8.143. So the economic value added, IVA, utachukua kama sasa hapa 37. Let me write, but for you si lazima uandike. You just write the answer. Use minus this 21.378. Hapa utasema now ni 95.25 minus 27.965. Na hapa ni 119.5 minus 30.8. So do the same even for this other one. And write your answers. That's how you compute IVA. You finished? Okay, good. I can see we have like 20 minutes, which I do not think will be enough to do what I wanted. So when we meet next, kindly remind me that we solve this question of November 2019. Question 4B. Remind me in case you realize I have forgotten, so that we are able to see the other way of computing IVA. And that area will be done. We go now to our next topic. We'll go to our next topic. So let's stop there for now. I'm going to send you the notes so that you can go through them. So as you have seen here, there is nothing much. It is just getting to know the formula of getting return on investment, the formula of getting residual income, and the formula of getting the economic value added statement. That's all. It's nothing much. Yeah. So as I've said, we stop there for now. When we meet next, we should start with this one so that we now wind up that area as we get to the next item. Thank you.